Hey guys, what's up? I'm Erin and welcome back to the channel. If you've been saving diligently for retirement and end up with a sizable traditional IRA or 401k, say $1.5 million, you might be wondering, how much will my required minimum distributions or RMDs be? And how much will I owe in taxes when those withdrawals start? So in this video, I want to walk through exactly what would happen when you turn, say, 73, when those RMDs kick in, how much you'd have to withdraw, how it might impact your Social Security benefits, and what your federal tax bill might look like. So if you're retired or simply planning ahead, let's break this down so you can plan with confidence and clarity. When you turn 73, the IRS says it's time to start drawing down on your tax-deferred accounts, like a traditional IRA or a traditional 401k. These withdrawals are called required minimum distributions, or RMDs. So if you turn 73 in 2025, that makes 2025 your first RMD year. But here's where things get a little bit sticky. For your first RMD only, the IRS gives you a special delay option. You can take your first RMD at any time in 2025, or you can delay it until April 1st of 2026. However, and this is important, if you delay taking your first RMD until April of 2026, you would still have to take your second RMD by December 31st of 2026. So that would mean you would end up with two RMDs in one tax year. This could spike your tax bill, it could affect your Medicare premiums, it could affect how much of your Social Security is subject to taxation. So in many cases, taking your first RMD in the year it's due, 2025 in this example, makes more tax sense. Also, a quick note about future RMD ages. Thanks to Secure 2.0, the future RMD age will increase to 75 in 2033. This gives you 2 more years of tax-deferred growth and maybe a little bit more flexibility with your planning. So let's run through a real-world example to bring this to life. Let's assume you turn 73 in 2025. Your IRA balance on December 31st of 2024 was $1.5 million. You decide to take your first RMD in 2025. The IRS distribution period for age 73 is 26.5. So to calculate your RMD, you take your account balance on December 31st of the previous year and divide it by the distribution period. In this case, we end up with about $56,600, or about 3.77% of your total account balance as your RMD. And yes, that full amount is taxable as ordinary income. So let's see how this might affect your tax situation, especially once we factor in Social Security. Let's assume this is a married couple, both are age 73 and filing jointly. They each receive $2,000 a month in Social Security benefits, which equals $48,000 for the year. They take their RMD of $56,600 and they have no other income or tax-exempt interest. Now we need to determine how much of that Social Security is taxable, and in order to do that, we need to calculate their provisional income. The IRS uses something called provisional income to determine how much of your Social Security benefits are subject to tax. Here's what that formula looks like. An individual's provisional income, or a married couple's provisional income, equals their adjusted gross income plus any tax-exempt interest plus half of the Social Security benefits. So if we plug our numbers in from our example, we get a provisional income of about $80,600. That is the number the IRS uses to determine how much of their Social Security benefits are taxable. So how much of their Social Security gets taxed is based on the 2025 IRS thresholds for married couples filing jointly. And here's what that breakdown looks like. For incomes less than $32,000, 0% of the benefits are subject to tax. For incomes between $32,000 and $44,000, up to 50% of benefits could be taxable. And for incomes above $44,000 for married couples filing jointly, up to 85% of Social Security benefits could be taxable. Since our couple has a provisional income of about $81,000, they are well above that upper threshold, but that doesn't necessarily mean that a full 85% of their Social Security benefits will be subject to tax. The IRS uses a phased formula, and here's what it would look like. Now we run the provisional income through the IRS's 3-tier formula for those married and filing jointly. First, we take 50% of the amount between $32,000 and $44,000. That's a $12,000 window, and that gives us $6,000. Then we take 85% of the amount above $44,000. In total, it's $31,113. Adding those together, we get $37,113. Since that's less than 85% of their total Social Security, which would have been $40,800, they didn't hit this cap. So we take the lesser of these two numbers. So their final taxable Social Security is $37,113. Next, we add their RMD to the taxable portion of their Social Security to get their adjusted gross income. In total, this gives us an adjusted gross income of $93,717. Now, let's subtract the deductions this couple qualifies for. We have the base standard deduction for those married and filing jointly, as well as the senior bonus that's tied to the standard deduction for those age 65 and older. On top of that, they also qualify for the new senior deduction from the One Big Beautiful Bill Act, which is $6,000 per person. Their total deductions are $46,700. Finally, we put it all together and calculate their total taxable income, which comes to $47,017. Then we apply the federal tax brackets. The couple sees a portion of their income taxed at 10% and another portion taxed at 12%. This gives them a total federal tax bill of $5,165. So after taking their RMD and adding in the taxable portion of their Social Security, this couple has a federal tax bill of about $5,200. Once your RMDs begin, they don't stop. Every single year, the IRS requires you to withdraw a portion of your account balance, and that percentage increases as you age. The IRS uses something called a distribution period, or RMD factor, based on your age. Each year, that factor gets smaller. So even if your portfolio stays the same, the required withdrawal gets larger. But of course, a well-managed portfolio doesn't stay the same. If you remain invested, it's very likely that your portfolio would continue to grow, which means your RMD in total dollar terms would likely increase over time. Going back to our previous example, if our couple only took their required RMD every single year and their portfolio continued to grow at a rate of 5% per year, by the age of 80, their required minimum distribution would be nearly $77,000, and their portfolio balance would be about $1.6 million. By the age of 85, their RMD would be closer to $97,000, and the portfolio balance would be about $1.5 million. So even after 13 years of required withdrawals, totaling over $900,000 in withdrawals, the portfolio would still have a balance of close to $1.5 million. So despite your withdrawals, your portfolio continues to grow and continues to compound so long as it remains invested. And with that, we can debunk a common fear, which is RMDs would deplete your portfolio too quickly. The truth is that with smart planning and a long-term growth strategy, even as you take your RMDs, your portfolio can remain quite strong. But there is a flip side to this. As your portfolio grows with time, so too do your RMDs, and so too do the taxes tied to them. So that means for the rest of your retirement, you're going to want to be mindful of increasing taxable income from larger RMDs, potential impacts on Medicare premiums, how RMDs might push you into a higher tax bracket, and how they could affect how much of your Social Security is taxed. That is why it's so important to think about long-term tax planning in retirement, not just investment growth. If you're looking at these rising RMDs and thinking, that tax bill is only going to get worse, you're not wrong. But there are two powerful tools that can help you take back control. Number one, Roth Conversions. A Roth conversion means moving money from a traditional IRA or traditional 401k into a Roth IRA. Yes, you pay taxes on the converted amount now, but there's a payoff. Roth IRAs have no RMDs, future growth is tax-free, qualified withdrawals are never taxed again. By converting strategically, especially during your lower income earning years prior to RMDs beginning, you can reduce the balance of these tax-deferred accounts. And that means you can have better control of your income sources in retirement and better control over your tax bill. And since this will shrink your RMDs down the line, think of it as prepaying your tax bill now when you're at a lower rate rather than paying it down the line at a higher rate. Let's revisit our example. Would it make sense for our couple to convert a portion of their traditional IRA to a Roth IRA in order to hopefully reduce future RMDs? In this example, the final taxable income after deductions was just over $47,000. The top of the 12% bracket for those married and filing jointly in 2025 is $96,950. That gives them just under $50,000 of room for a Roth conversion. If they convert that amount, they stay within the 12% bracket, so they maximize their bracket and take advantage of the lower tax rates available today. Now, one quick note, with this conversion, their adjusted gross income would come to about $144,000. This is still under the phase-out range that is tied to the new senior deduction for those married filing jointly. It starts at $150,000, but because this deduction is tied to income, it is something you want to be mindful of if you're in the middle of doing a conversion. But this kind of strategic conversion could certainly lower their future RMDs, it could reduce their total lifetime taxes, and give them more control of their retirement income. Now, the pros of doing this are, number one, to reduce those future RMDs. Every extra dollar you move into a Roth IRA reduces your balance of your traditional IRA, and that can reduce your future RMDs and your future tax bill. It locks in today's lower tax rate. If you're paying 12% on a conversion today, this could lock in a lower rate. If you're expecting your RMDs to increase and potentially push you into a higher tax bracket, or if you're expecting these tax brackets to increase over time, you could lock in a lower rate today. More tax-free growth. Once that money's in a Roth, it gets to grow completely tax-free. Withdrawals are never taxed again. This is a total win for long-term retirement planning and for your beneficiaries. And simply, there's no RMDs on Roth IRAs. Unlike traditional IRAs, Roth IRAs have no required RMDs during your lifetime, which gives them the ultimate flexibility when it comes to retirement income. Now, because this is not one-sided, here are some of the cons of converting up to the top of that 12% tax bracket. You get a higher current year tax bill. If this couple converts $45,000 to a Roth, it would increase their federal tax bill by nearly $4,400. They'd need to have this amount available outside of the IRA in order to make that conversion worthwhile. If they have to use the funds from the conversion, it could reduce the long-term benefit. This conversion bumps up adjusted gross income and provisional income. This can push up the portion of Social Security benefits that are subject to taxation. It can increase Medicare premiums down the road, IRMA surcharges, and it can also disqualify you from certain deductions and credits, so check on your situation specifically. And remember, it's irrevocable. Once you do a Roth conversion, it's final. You can't go back and undo it if you later change your mind. The bottom line is that doing a Roth conversion up to the top of the 12% tax bracket could be a compelling strategy, especially if you can afford the higher tax bill from other savings, if you expect higher RMDs and higher tax rates in the future, and if you want to leave behind tax-free money to your heirs. But as always, make sure that it would fit well within your broader income and tax strategy. Because remember, even a good conversion can backfire if it has negative consequences elsewhere in your plan. It could be worthwhile to consider Qualified Charitable Distributions, QCDs. If you're 70 and a half or older, you can decide to give to a charity. A QCD makes it possible for you to convert from your traditional IRA or 401k directly to the charity. And here's the thing, that does not get taxed as ordinary income. You are allowed to give up to $100,000 per year. It satisfies all or part of your RMD, and there's no itemizing required. You get the tax benefit either way. This is a fantastic strategy for generous retirees who don't need all of their RMD income. It allows you to support the causes you care about while reducing your taxable income. Roth conversions and QCDs are really about regaining control about how and when your retirement savings are taxed. Want more flexibility in the future? Roth conversions can help. Already giving to charity? QCDs can save you serious money on taxes. With traditional accounts, RMDs are a fact of retirement, but with smart planning, they don't have to be a burden. So the takeaway is to start early, plan smart, and remember, the more control you have now, the more freedom you have later. What are your thoughts on Roth Conversions, QCDs, and what do you think about RMDs? Will you face them in the future, or are you finding a way to avoid them now? Let me know your thoughts in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. So sorry. And this is important to keep in mind. I didn't like how I said important. In 2025, your IRA balance on December, did you hear I said IRA? I don't like it. All tax situation, especially who don't need all of their RMD income.